All right, good afternoon, everyone. Audible? Before starting, I just want to check something here with maybe some of our traditional finance friends here. Is there anyone that has experience or is working with derivatives and their work somehow involved? Just raise a hand. Okay, so a couple of hands, that's nice to hear. And it will be, for the rest, somewhat educational. So I come from a company called LimeChain. We're a blockchain development and consulting company that's on the market since 2017. And we've been through all of the ups and downs of the industry. And we're very excited about the recent developments with stablecoins. So the regulatory approval, stablecoins are basically going to change cross-border settlement and payments. But stablecoins are only the beginning. How do I change my slides? All right. Stablecoins are only the beginning of a much larger foundational shift in global finance. And today I want to talk about actually one of the world's largest financial markets, which is the over-the-counter derivatives market, and how smart contracts can be the next infrastructure layer for it. So starting off with a brief overview about what this market's about. There's actually, as of the end of 2024, $700 trillion in global notional value of derivatives contract, which is obviously a mind-boggling number. It's not completely representative of the market size. That would be the 17.6 trillion, which is the gross market size, because a lot of these cancel each other out. And how is this actually, what does it consist of? So mostly around 80% of that is going towards interest rate swaps. The second biggest category is foreign exchange swaps, and the rest of that credit defaults and equity derivatives. So as of today, all of this value is running on very manual and fragmented infrastructure. It's basically bilateral agreements between institutions, banks, and their counterparties, and there is low standardization. There is a organization that is governing this called ISDA, the International Swaps and Derivatives Association, and ISDA basically defines three components which are standardized. First is the ISDA Master Agreement. That's basically the legal document that binds the parties together and makes the contracts legally binding. Second is the Credit Support Annex, and this is basically the main document that's designed to mitigate counterparty credit risk, which is the risk that your counterparty will go in default throughout the duration of your agreement with them. Thirdly is the common domain model. So ISDA has taken a first step towards optimization of these agreements. And the common domain model is a machine-readable model for trades and lifecycle events. So we can say that the ISDA framework defines the logic, and there is some movement towards automation, but the execution of the agreements is usually manual. So let's look at the Credit Support Annex. What does it basically define? And it defines 4 pillars, which are the bilateral rules for credit risk. So first of that is the collateral eligibility. They define what kind of collateral can be used there, cash, bonds, something else, and nowadays, hopefully, stable coins. The margin threshold, meaning the amount below which counterparties should exchange margin if it is passed. Thirdly is the frequency of collateral settlement, be that daily, weekly, or based on some event. And finally, the valuation. So they're outlining in this document how the collateral should be valued mark to market. There are a lot of frictions with the execution of the ISDA CSA, and that introduces operational costs and hidden risks in the system. So the counterparty credit risk, which we mentioned before, the fact that we currently have T+1, sometimes even T+2 settlement, that creates residual exposures. Banks must raise capital to cover that exposure, and that has a high capital costs associated. Secondly, operational inefficiencies, daily variation margin exchanges, collateral calls, and settlements. So there's a lot of moving capital around constantly, and of course, teams which have to serve that in banks, which is, again, a large cost. Thirdly, valuation disputes. So a large percentage of the margin calls are disputed. This results in lengthy dispute resolutions due to conflicting valuation models of the collateral and can delay collateral movements and make the process even slower. So there are two major strains to financial institutions' P&L in this OTC derivatives market. As mentioned, the high operational cost because of back office, overhead, dispute resolution, and manual processes. And secondly, it's the counterparty credit risk mitigation. So banks must freeze additional capital to cover CCR and potential credit valuation adjustments. And again, a disclaimer, the CVA, that's the probability that your counterparty's credit rating would go down, not default. Now, our team ran some numbers as to how costly this would be for the European financial institutions. And based on some data from the ECB, we established that CCR CVA mitigation can lock up to 95 billion euros in capital yearly. So that's money that's essentially locked up, can't be earning yield elsewhere. And so the question becomes, what if we could use smart contracts as the keystone to a more robust and efficient derivatives market? So a derivative smart contract, which basically translates the CSA instructions into self-executing code that's running on the decentralized ledger. And this would yield the following benefits. Firstly, that we would have automated valuation of the collateral because the parties would predefine the valuation model and they would rely on external data feeds that are secured, which in the crypto world we call oracles. As a result of that, we would eliminate basically the possibility of disputes. The contract will serve as a single source of truth for both the parties and basically increase efficiency. Third is the near instant settlement. So with the acceptance of stablecoins and other forms of tokenized collateral, we will basically reduce the settlement risk from days to seconds, which is a very large improvement. And finally, deterministic termination. So in the terms of the contract, we can define the terms of potential default. So when this condition is met, basically the contract would liquidate the collateral and terminate automatically without the need for costly legal intervention. Sounds very good in theory, but how do we implement this in practice? And I want to bring our attention to two Ethereum improvement proposals. So these are standards in the Ethereum ecosystem for smart contracts, which basically are used to implement some certain use cases. And more specifically, it's the ERC-3643 standard, which is the compliance layer. So this basically turns all tokens into compliant tokens, KYC, AML verified, so that the institutions can transact in a compliant manner. And secondly, the more complex part is the ERC-6123. This is the execution logic. So basically what we talked about with the CSA instructions, that would be the algorithmic engine that defines the on-chain derivative logic. So going deeper into the 6123, its objective being fully automating and securing an OTC financial derivative contract and completely eliminating counterparty credit risk from that process. There has been a pilot project carried out by University of Munich, LMU, and DZ Bank, where they basically claim that this can be achieved by implementing this as infrastructure. And again, the terms of the contract that are defined are the trade inception and the confirmation of the trade, settling cash flows on a regular basis, like what are the rules to achieve that, valuing the collateral with smart contract oracles, and the contract termination terms. So even if we let's say we don't eliminate CCR completely, but we achieve a cost reduction of 70–80%, that's still savings in billions, only from this for banks yearly, and that's not accounting for all of the operational efficiencies. So to demonstrate this, basically just to compare the current approach and what the life cycle would be if we were to implement smart contracts for this. Currently, representation of the trade and event data is described semantically, but it would also be encoded in executable code on a single shared ledger between the parties. Secondly is the valuation. No longer do we need separate systems for each party to value their collateral. We reference the on-chain oracles. Thirdly, margining. Parties don't have to issue and respond to margin calls manually and deploy a lot of human capital in order to do this. Margin adjustments can occur automatically via the code. Settlement, no longer do we need T+1 settlement and settlement risk. This is achieved by atomic delivery versus payment and settlement that's happening in seconds. And the reconciliation, which is happening in banking systems daily across systems, is also reduced because there's a single shared state on-chain. This is a quote which I think, based on a lot of the talks today, is basically a fact by now. It's from 2020. Adoption of blockchain may not be a choice. And the fact that we have so many institutions here and incumbents basically confirms that. And although this might be a revolution for traditional finance, this is the foundation upon which DeFi was built. So a trustless environment where contracts can be programmed and executed automatically. And I just want to show how DeFi protocols are proving the potential for on-chain derivatives already today. And I will do that by giving the example of two DeFi protocols that are currently wildly all the hype. The first one being Pendle. Now, Pendle is quite a complex protocol, but essentially what they do is they take some yield-bearing token, such as, let's say, yield-bearing stablecoin, and they split it into two parts, principal token and yield token, so that they can independently be handled with and traded. Essentially, by doing this, trading in PT and YT can be equivalent to an interest rate swaps, where you're exchanging fixed for floating future cash flows. So Pendle has proven that they can achieve this via smart contracts, and their year-on-year growth in total value locked in the last year is from 2.5 billion end of 2024 to 7.12 billion as of September. So 184% growth. This might be a small number for banks, but with this growth rate, we can assume that it's very successful, growing very quickly, and it might be a matter of keeping up with open protocols that are already existing for banks to keep up. Secondly is Morpho. Morpho is not exactly a derivatives protocol. It's one of the leading lending and borrowing protocols in the DeFi ecosystem, but it's also very suitable for institutions. So what it offers is smart contract-based rate discovery, collateral management and valuation, and institutional-grade asset management vaults. And Morpho is being adopted by currently the Banque de France, Central Bank of France, is running a pilot project of creating interbank on-chain repo market on top of the Morpho infrastructure. So also quite a high potential for stepping in and using DeFi to create traditional financial products of the future. Also widely successful in the last year, growing from 2.5 billion in total value locked to 11.6, so a 4.5x on TVL. Now, of course, this change cannot happen overnight, and there are still some hurdles to overcome so that this transformational shift can occur. Stablecoins are a very good first step, but we have the following hurdles. So firstly, the legal enforceability. There's still an uncertainty over the enforceability of smart contracts, the code versus law discussion, and jurisdictions in cross-border disputes. Secondly, there's a risk of technical and operational implementation. So are the oracles which are being used secure enough? We have to really make sure that that's the case and the information that's coming out of them is correct. And the integration with complex legacy systems can be a challenge as well. Thirdly, regulatory capital recognition. So the regulators must also acknowledge that this process is achieving the savings and reducing the risk so that the capital that's coming from atomic settlement can really be freed. We at LimeChain have it as a mission to technically and strategically empower institutions to stay ahead of the trend. And we have 3 suggestions on how to achieve that. So firstly, technical empowerment. Basically start small. Start with small pilot projects to see how this technology is working, understand it better across your organization, and basically see how it works. Secondly, in these pilot projects, you have to align management, technology, legal, and internal audit from the outset of the project. And finally, establish clear and measurable benchmarks to prove the business case of compliant and efficient tokenization, and to make sure that this is secure. So we envision a derivatives market of the future, which is running 24/7 with less counterparty credit risk, a more resilient and robust and efficient system running on smart contract infrastructure. And we would be very happy to build with you. So in case you're interested in this or other institutional use cases, we have a booth right there in front, and we'll be happy to talk. Thanks.